Well, good afternoon, ladies and gentlemen. Happy Friday, July 24th to you all. It's great to see you all here, of course, for our Power Options Radioactive Trading Open Forum Q&A session. I hope you all brought your questions, of course. We've got about 10 to 12 now, 13 people in the room, it looks like, and we're expecting another 12 or 15 or so, so we may have as many as 30 people in the audience today. So we've got a lot of questions probably going to come in. And we've got a lot of ideas to probably cover as well. Before we begin today's presentation, I just want to introduce, of course, what is Power Options? Well, of course, Power Options is a patented suite of search and analysis tools designed for self-directed options investors. Our tools allow you to search across the universe of options in over 23 of the most commonly used option strategies to quickly identify only those positions that match your personal risk-reward tolerance. Once you've identified the position, we can quickly compare the risk versus reward and do further research and analysis on our underlying securities or the option itself. And we do, of course, offer a powerful set of portfolio tools to help you paper trade, track, and manage your positions. In addition to that, we offer countless educational articles, help pages, help videos, and archived webinars to help you get more familiar with the various tools on the site and also the various option strategies, management techniques, and ideas and tips for entering positions as well. Ernie Zarrena created these Power Options tools about 17 years ago, back in 1997, really to trade his own personal accounts. He decided shortly after that to put it up on the internet, but of course everyone on staff at Power Options uses these tools to trade their personal accounts, myself included, so we have many more years of combined trading experience. Now, for those of you who don't know me, my name is Mike Chupka. I'm the Director of Education here at Power Options. I've worked with Power Options and been a self-directed trader myself for the past 12 and a half years, really. I do handle a lot of the coaching sessions and education on the site. If you're a trial member or subscriber to Power Options, you can schedule one of those free coaching sessions at any time. And I do, of course, handle a lot of the education on both Power Options and radioactive trading. Kurt handles the webinars at Radioactive Trading and most of the blog articles and other information, but a lot of the customer service and a lot of the blog article ideas will come from emails that we've had with customers as well. I have co-authored 2 books with Ernie, and I am versed with all strategies on the site. I haven't traded covered calls in probably about 10 years just due to the risk-reward ratio, and I was never consistently profit with that strategy or a couple others. I've never actually traded iron butterflies, short straddles and short strangles, or selling naked call positions without owning a call or owning a stock to protect it. But if you do have questions about those today, we'll be more than happy to show you the tools or discuss potential management techniques in those strategies as well. Our process and procedure for this afternoon's presentation: when you logged onto the webinar, the GoToMeeting, GoToWebinar platform would have appeared on your screen. Inside that platform is a message pod or a question pod. So just open up the question pod, type in your question, and send it to us. Please feel free to ask as many questions as you want. We're scheduled to be here from 4:30 p.m. Eastern to 5:30 p.m. Eastern Time. But if we do have a high volume of questions, I'll be more than happy to stay online to continue to walk through some of those questions with you if we need more time to make sure that every question is addressed. Your questions can really be about anything. If you have questions about general options strategy or just options in general, what is the difference between delta and gamma? How do I use delta in my trading? What should I look for implied volatility? What is implied volatility? How do you know if an option is good value? What is a good time frame for entering a bear call credit spread or entering a long call position? If you have direct questions about the tools on Power Options, using the search tool, entering trades, or managing trades in the portfolio tool, for example, that is all fair game. And of course, if you have any questions about the radioactive trading concepts in general or the income methods, those are free game as well. Our basic ground rules for the presentation: don't be shy. Please feel free to ask any questions that you want. This presentation is designed for you to have an open and free forum to have your questions answered, so you want to make sure you take advantage of that while you're here. We do ask you to be patient. There may be 1 or 2 questions ahead of yours, but as I mentioned, I will get through them all. We also want to encourage you to feel free to help us help others. If a question comes in and I give a response based on my market experience, what I've traded in my personal account in the past, management techniques, or looking for a new position, and you feel that there's something I glossed over or something that you use in your account that's beneficial for selecting a trade or managing a trade, use the question pod and send that to us, and we'll share that with the rest of the audience as well. Most important, let's have fun. Let's get some good education under our belt. Get ready to go into the weekend, of course, and then get ready for next week's trading as well. All right, well, all that being said, now we're going to navigate over to the Power Options suite of tools. I encourage you to send in your questions at any time. We've got one or two questions that have already come in. So just I'm going to prompt you occasionally, but just feel free to send in your questions at any time. So we've got one or two that have already come in. Okay, so the first one is related to true calendar spreads. Okay, James asked the questions, could you show some ways to use Powerup to manage open calendar call spreads, debit spreads, when the market used against you, same strike, different expiration dates? Okay, well, I'll take one example from yesterday that we saw a change today, of course, and we'll see what we can do with that. Let's go back, and I'm just going to go to the option chain here for ETFC, E-Trade. Let's just go into the chain, and I'm actually going to go back a previous day or two. Let's go back 2 days here. All right, so we're going to go back to Wednesday, the 22nd, when E-Trade was currently trading at $30.19. Now, what I'm going to do is I'm going to go out here. There's 2 days left here, so we're going to stick with the July 31st weekly for our short option. And I'm going to, let's do just calls only. Okay, let's just do calls only here. There we go. So this is just our basic chain, and I'm probably going to look to sell the 30.50 slightly out of the money, or the 31, maybe even the 30. Let's do the 30. That'll be a good sort of at the money trade. The stock's at 30.19. It's closer to 30 than it is to 30.50. Maybe I'm cheating a little bit, but we'll go ahead and use the 30.15 if it looks right. I'm sorry, the $30 one if it looks like. Now, I'm going to want to go out a few weeks out in time here to give me some time to manage it, not just 1 week apart. So seeing the available expirations on that day, we would have had the 31st is 9 days out, so 16. So the 23, this would have been about 30 days out, August 21. All right, so let me go ahead and hold and check the hold box there on the right to hold the July 31st weekly. I'm going to select August 21 as well, 30 days out exactly. So, wow, nice premium, nice potential calendar spread, but let's take a look at it. What I'm going to do here is go to the custom spread tool, and we're going to go ahead and sell the July weekly. Of course, remember this would have been done on the 22nd, July 22nd, and we're going to sell the 31st, which expires next week. But we're going to sell the July 30, 81 to 88 cents, 7 cent spread, so let's assume we could get 84 cents for it, close to the midpoint price on that one. And at the same time, we're going to buy the same strike, but 3 to 4 weeks out, essentially 4 weeks out in time, 3 weeks further out in time. The 30 strike there, 110 to 120, so we're going to say a midpoint of 115. Right, so 84 cents on the sell, 115 on the buy for our 30 strike options. Let's go ahead and graph this first and see if the spread even makes sense before we enter it. So I'm going to go over to the custom spread tool now, and let me clear out the drawings there since they're no longer relevant. All right, let's go ahead and put in ETFC. And again, we're going to go ahead and select to sell the July 31st 30 strike call. This was assuming it was similar to Wednesday if we were doing this on Wednesday. And we're going to just sell one contract. Let's keep the math simple at about 84 cents. At the same time, we're going to go to August 21, which at the time was 30 days out in time. And we're going to buy the 30 call there. And at the time, oops, nope, I don't want to sell. Sorry, folks. At the time, that would have been 115. All right, so let's go ahead and submit that. Ooh, reasonable calendar spread. The break-evens are kind of tight, 28.72 to 31.40, but it is a shorter-term trade, so we could kind of expect that as well. All right, so let's go ahead. That might be our same strike calendar spread we'd look at here. All right, so maximum risk is $31. We're getting a great premium here of 84 cents up front. We only paid $1.15 for the 4-week out option, and we could make as much as $50 off of that $31 investment. So technically, if the stock was trading right at 30, we'd have 161% gain on the position. All right, so this is the spread. This is what it would look like if we opened this particular 30 strike calendar spread on Wednesday the 22nd. As you can see here, the stock's at 28.50, so we've seen a decline. It's below our static break even for next Friday expiration. So let's go ahead and add this to portfolio. From the custom spread, when I click add to portfolio, it gives me a choice here of which portfolio I'm going to want to enter it in. We're going to create a new one. And I'm going to call this Open Forum July 24th. Just make it easier to see without all the other positions hanging around. All right. We're going to insert our trade. The system already knows which option we were selling, which option we were buying, for example. So let's go ahead and submit that. Okay, so we've got one calendar call spread. And because of the decay and the change in volatility, the reason why these premiums look so good is because we had earnings on E-Trade come out at the close of business yesterday. And of course, the stock's down about $1.20 today. It dropped further down prior to the earnings. Then it dropped about another $1.90 today as well, 92 cents, excuse me. So remember, the option that we sold at 84 cents has now dropped to 18 cents. So we've made 66 cents in the short option in our favor. It's declined, so we could buy it back cheaply for only 18 cents. We've made 66 cents. However, that 115 that we bought that was also inflated, now with the stock down to 28.50, even though we still have 28 days remaining, is only down to 32 cents. So we're down 83 cents on that position. So our total portfolio right now, we're down roughly about $17. We're down about 20. No, yeah, I was right the first time. I'm sorry, folks. We're down a total of about $17 on the position. Okay. Now, if you take into account the 83 loss we have on the first one, $66, we're down $17. Well, now that the spread has moved against us, the first thing I might look at is, as I'm tracking the position in the portfolio, let me back up one step, James. Before I would have done this, of course, what I would have done after I entered the trade on Wednesday, I would have gone into the alert section here by clicking on view. And I would have set a strike price limit or stock price limit based on my expectations, decrease in the total position, or maybe days to expiration on the short option. I would have set some of my different positions here. So if my position has lost more than, maybe for a calendar spread, it's a leverage spread trade, so let's say lost more than 25%, we'd want to be notified. Of course, if we've increased the position by more than maybe 50%, we'd probably want to know as well, and that would be profitable. We might go ahead and close early. Now, I know, James, you probably would never do this position right before an earnings event, or you might, but I'm going to show this just in the broad scope of how we might manage this in the portfolio. We could set the lower limits. I'm just going to use the percentage decrease. And of course, if at the time, any position, if you looked at a bull put credit spread or a bear call, and you had a requirement when you ran your search that the stock would be trading above the 20-day or the 50-day moving average, I'd set an alert to be notified if the stock was trading below that 20-day or 50-day moving average, whichever fundamental I use as part of the screen as well. All right, well, let's just go ahead now and save the alerts now that we've seen where that is. And of course, now an alert's been triggered. And if I click on the alert, it shows me, of course, that we've lost more than 25% or so, I believe, on this position. Yes, we've lost 54.8% on the original debit of the position. Okay, so we have a decrease in the position. Now we need to manage it, perhaps. So the first thing I'll do is click the More Information button. I'll go to Position Actions and then Position Analysis. The position analysis gives us a breakdown of our current position. We know the profit and loss chart. We just saw that before. We know where our options stand right now. Stock's at 28.50. If we liquidated the position right now, we have a loss of roughly $17. But if we hold the position to expiration, we get that remaining 18 cents, assuming the stock stays below 30. But if we hold it for the next week, we get that extra 18 cents back, and we'll have a much smaller loss on the position than we do right now. Current liquidation value is $14. Remember, we paid $31 to get into it. The expected value of the position, if that remaining 18 cents decays in our favor, would be $26.21, so we're only losing $4.79. Remember, the debit was 31 cents, so it's a pretty significant loss off of that position. Now, in a lot of situations, what you'll see here is a section for rollout opportunities. We'll see that in covered calls, diagonal spreads, naked puts, bull put credits, just about any strategy I'm trading in power options. As the stock moves up and down, we'll see that. Right now, we're not seeing any for this particular calendar spread. It's probably because the system didn't like some of the default criteria we put in the background for the management, and it didn't like the gain or loss that it was seeing, or potentially a further loss on the position. But it's okay. Now that we don't see any rollout opportunities on this position, I can always use the what if calculations to help me see if there's any viable adjustments for this particular calendar spread. So if we click on what if calculations, that's just going to take us back to the custom spread tool. All right, so when we go back to the custom spread tool for our particular position, we see exactly where we are in relation to the original price, and of course we can see where our loss is right now, or where we are close to being on a loss position. So now that the stock's down to 28.50, what are some things I might consider? Well, the first and most obvious one for me for a calendar spread, whether it's a diagonal or in this case the horizontal, is I may consider buying back this call that we sold for 84 cents for only that 18 cents, or the midpoint, and then selling to open the lower strike. So I may roll from the 30 down to the 29, still 7 days remaining on the position. And how would I do that? Well, I'll go into that particular month. The 30 call is the one we purchased, and we see now that we can go ahead and sell this position, or buy it back, I should say, for 18 cents. Well, that's the worst case scenario with the ask. With a bid of 4 and an ask of 18, we've got 14 cents between. If we get filled at midpoint, we'll get 11 cents on this position. So I'm going to go ahead and buy this back for 11 cents. So we're going to keep 73 cents to lower the cost basis of our August 30 call that we purchased. I'm sorry, August 21st call. So now if I just submit that with having sold the July 31st 30 call for 84 cents, buying the July 30 call for 11 cents, I see now that essentially I'm just left with a long call with a cost basis of $42. Okay, that's accurate. We kept the 73 cents, take that off our cost of 115. We now only own the August 30 call with a cost basis of 42 cents. Can we mitigate that some? Well, let's see. If we go back to the same expiration for July, we could cut it in half. The July 29th, rolling down a little bit, taking a chance here that we don't think the stock's going to recover, and we think that it dropped here because the earnings it's going to stay down in price. Well, this shows me I could cut at least half of that off. Again, 21 to 28 bid-ask spread, 7 cents difference. So let's say we could sell this for 24. So we click on the 29 call. Now shows me it's been added. And I'm going to put that we're going to sell this one for 24 cents. So now our total debit into the position is only 18. We still have a reasonable range of profit. What have we done here? We've extended our upper and lower break-evens to Friday. Well, we've extended our lower break-even down to 28.12. Now we've put our upper break-even at 29.34, and that might be okay, depending on your expectation for the stock over the next few days. We still have a profit available, but here the profit's a little bit different. The profit's only $22, but there's a trade-off here, isn't there? Notice how that my cost basis into this position is only 18 cents. But because I've sold the 29 short term and I've bought the 30, even though this was done at a debit, my broker may require me to put up $100 per contract because my short call is now lower than the call that I purchased. I'm technically in a credit spread now that I've paid a debit to. But if the stock is trading right at 29, we still could make about $22. That's about half of what we originally expected to make with the 50 cents, but we're trying to get a better upper and lower break even based on where the stock is now, because remember, liquidating right now is a loss. Now the stock could drop maybe another 40 cents or so, and we could still be in a profitable range where beforehand we're at a loss or where we are right now. Okay, so that's one general idea you could do. If we wanted to roll for a better premium, of course, we could go out further in time. Rather than keeping the same July 31st expiration with that 29 call, maybe I could go out to August 7th. All right, go out another week, and we can get 38 to 45 cents, so roughly probably about 40 cents or so, 41 cents, instead of the 22 cents we were going to sell it for. All right, so you can sell this one for, I didn't say 44, I'm at 41 cents, that's right, 0.41 between the bid and the ask. Very similar calendar spread. But see, now the max, that's not accurate. Let me change something here. Now that I'm going to different expirations, I need to close this out here. I need to take these two out. So we sold it for 84, bought it back for 11. We're keeping 73 cents. Remember what that did to our position? Our long call would have only been worth 42 cents. So remember that when we showed the position that the remaining we had in our long call was only 42 cents. We're selling one strike lower 29 call for 41. So now we've only got $1 in the position. The strike prices are subtly different. Okay, so we may have to put up that $1 for the monetary requirement as well. But in this case now, we've greatly extended the upper and lower break even by going out an extra week and almost paying for the entire position as well. So depending on your outlook for the stock, and of course, if I thought E-Trade was going to recover and might move back up to this price, might go back to $30 or $30.50, there was just an overreaction to the earnings and an overreaction to the earnings plus the general market pull down today as well, then I may want to just close that call, that short call right now for a cheap price and wait for an opportunity to sell a 30 strike call or maybe even a higher strike call if the stock recovers and moves back above 30. So when you're tracking the position again in the portfolio and you use the edit more information button next to your position to link to the position analysis view, if you don't see any rollout opportunities, then you're going to want to just click the what if calculations. And then as you go to the what if calculations, you'll be back on your original spread and you can start adjusting the position on the fly to see if the idea that you had of how you think you'd manage the position matches your goals, matches your return requirements, and at the same time gives you the upper and lower break even you're still comfortable with for your expectation of the stock going forward the next 7, 14, or maybe even 20 days as well. But a lot of times, let's go back to the portfolio here. And a lot of times in calendar spreads, you'll see it too. It just didn't come up for this one because it didn't like the risk-reward ratio, I don't think. But let's go back to the, I'll just go to this one real quick. And I want this one here. So if I'm in a position that, has a gain or has a loss, whether it's a calendar spread again, a covered call, naked put, a standard collar spread, a bull put, bear call credit, any strategy, you see the same view in the position analysis where you have a profit and loss of your current position, where the position stands right now, and then you'll see some opportunities for rollout opportunities, different scenarios that might help you take a losing trade to a winner, perhaps expand your upper to lower break even, maybe generate a little bit more premium for you as well to mitigate the loss, but you'll have some opportunities there as well that you'll be able to see to help adjust the position. Okay, but if you don't see any rollout opportunities there, just link to the what if calculations or the custom spread tool and try to manually build some adjustments on the fly as well. Okay, all right, so let's move on to question number 2. Joe asks, can I limit my evaluation searches to a group of pre-selected stocks? Let's say I'm looking for a credit spread, has a great ROI, and is 30 days out. Well, of course, but it all depends on what criteria is available. There's many ways to do that. So I can go to bull put credit spread now and I'll go to search. You can use the default criteria as a stepping stone to create your own personal search. We have initial values, weekly bull puts, for example. But let's go ahead and run this initial values real quick. We see some names in here: SanDisk, Halliburton, GoPro, Yahoo. Some of these may be too volatile for you. All right. So if you want to create your own search, Joe, it's extremely simple. Okay, based on your personal criteria, I can do one of two things. If you have a specific list of stocks do you want to screen against, just click on the list tab. So when I pull up any search, I've got the available trades. I scroll below the available trades and I've got the parameter field here, which shows me the criteria that I can go on adjusting these positions. So I'll go to lists. And now, if I wanted to, I could choose to screen just against stocks in the IBD 50, CanSlim list, Dow 30 Industrials, S&P 500, S&P 5 stars, or you can click the button here for Create and Modify Lists, and you can input your own personal stock symbols. Okay, you can create a list, plug in your stock symbols, and choose just to screen against those stocks. Now, what I would do first is I'll go ahead, you want to look for bull put credit spreads that are 30 days out. I'll go ahead and select Clear Filters. That's going to empty everything out of my parameter field. Now you want it to be about 30 days out. Well, I know August coming up expiration, the 21st standard August expiration is about 28 days out. Oh, sorry folks. So what I'm going to do is leave my option expiration time frame at all months, I'm going to tell the system to go 25 to 35 days out in time. So I'm only looking at options that are around 30 days out in time. You're going to have a requirement for your net credit that you'd want to receive. So let's plug that in. Let's just say it's 25 or 30 cents. I'll start it with 25 for now. With a 30-day trade, I probably want to be at least 4 or 5% out of the money on the short put. I'm going to go ahead and put in my probability of at least 75%. What I mean by that, the theoretical probability the stock will be trading at or above my short put strike price at expiration. And in addition, I'm not going to worry about implied volatility. I'm not going to worry about percent return because I'm more focused on the net credit at this point. I'm not going to worry about the strike difference. I can adjust that later. The other thing I'm going to do is put in some liquidity factors. I want to see options that maybe trade at least 10 contracts today and have an open interest of at least 50 contracts. Now, at this point, I've got what I want for the option spread, other than maybe setting a strike difference, but we could set that as well. But I've got my days to expiration, my minimum net credit requirement, my probability, range out of the money, and some liquidity. Now, if I'd created my own list, or I just wanted to screen against a specific stock list, I could just go to lists. I'll go to include. And if I created a list, I would have named it. It'd be here for me. But now I'm just going to select, let's go with S&P 5 stars. Those stocks rated 5-star rating by Standard & Poor's. Let me go ahead and click submit. All right, so we've got 4. I've got Avago, Skechers, Goldman, FedEx, and another Avago and GS that match my criteria. So believe it or not, of all the stocks that are on S&P 5-star list right now, there are only 6 trades that are within 25 to 35 days out in time that have a requirement of minimum 25-cent net credit, or at least 4% out of the money in short put, have a 75% probability, and I saw some action today as well. All right, well, if you didn't create your own stock list from scratch of stocks that you follow, or you didn't want to use one of the pre-programmed lists, such as the S&P 5-star, what I would do now is we would just put in the criteria you want. So I could go into fundamentals. Stock price isn't an issue because we're in a spread. We're selling one put and buying the other, so we're not concerned about the underlying. Maybe we're just concerned about the difference in strike prices. If I want to see just those stocks, because this is now a bull put credit spread, it's a bullish stock. If I only want to see stocks that have grown in earnings from last year to this year, I might put in earnings per share growth of at least 5%. I might put in a PE ratio of 0 to 70. Keep a PE ratio reasonable. And if I wanted to see only mid to large cap stocks, well, I might put in a requirement here. And as you hover over any of the filters, it might give you a tip of what to put in. This particular filter is measured in millions. So mid cap starting at 2 billion. If I only want to see mid to large cap stocks, I'm going to use a market cap greater than 2,000. Now I can go into the technicals. If I want to look for stocks that have shown a positive beta, for example, or have a reasonable average stock volume, this one's measured in thousands. So I'm going to put in 750,000, or 750, I'm sorry, Joe. So I'm only seeing stocks that trade on average 750,000 shares per day over the last 90 days. If you had a volatility requirement, you could put that in. Relative strength index, broker recommendation, Bollinger Band and Bollinger Band ranges, simple moving average, going about 30 days out in time. So I'm going to only look for stocks that are currently in an uptrend. I want stocks that are trading above their 50-day moving average. And we have other things where you can see how many days the stock has been above the 20-day moving average, the 50-day, or you can use the MACD as well, looking specifically for stocks that have been a number of days where the MACD has been over the signal line for a certain number of days to show more of a pronounced trend. But I want to keep it simple. Okay, everything over here on the right in the active filters menu is just what I've put in to my current search. I'm looking for bull put credit spreads on stocks that have an average volume of 750,000 shares per day, currently trading in an uptrend, have shown positive earnings, have a relative PE ratio, and I only want to see mid to large cap stocks. At the same time, my spread requirement, I want this, to be about 30 days out in time, minimum 25-cent net credit. I want to be 4% out of the money or more for my short put, a little bit of cushion there, and a 75% probability and some liquidity today as well. Now let's go ahead and run that search. Just click submit. I just put in a few basic criteria because I wasn't using a stock list. With just those basic criteria, there are only 10 positions right now, 10 bull puts that match my default requirements. Now that could be simply because I put in too high of a liquidity for the option volume today. Well, only 1/10 of our current optionable stocks offer weekly options. But we know that those stocks that offer weekly options, most of the activity is going to be in the nearer term, 1 to 2 to 3 weeks out, maybe not 4 weeks out. But also with things that they've been going recently, with earnings coming up and so forth, a lot of positions that are 4% out of the money or more might not be giving us the 25-cent net credit as well. So if they were out there, the system would find it. But even without using a stock list, of course, a lot of stocks probably aren't above their 50-day moving average after the last couple of days or so of downpull in the market. Google's big jump, of course, jumping from whatever it was about, it's about 570 up to about 650, and it gone as high as 690, but it's pulled back now the last few days, but it's still probably well above its 50-day moving average. So these are some opportunities. One other thing I would recommend whenever looking at a bull put spread, whether you're looking 7 days out, 14 days out, 20 days out, in the fundamentals, I'm also going to check the box for earnings date, not between now and expiration. Let's see if that removes any of our positions. Yeah, we removed a couple. So now we only have 6 bull put spreads, 3 of which are Google, that match that new criteria. Okay, VeriSign, Harley-Davidson, and Boeing are also in that list. And remember, I'm not screening against the list anymore. These are just the ones that match that basic criteria with the good liquidity, positive earnings, relative PE ratio, mid to large cap stock, no earnings coming up, and the stock's greater than the SMA 50. And then we put in our basic requirements. I'd see more positions if I removed this requirement for a stock currently being in an uptrend, okay? Or if I removed one maybe of positive earnings, because we've had earnings come out, so if that puts some companies negative based on the last quarter's earnings, if we remove that, we'd see more as well. So you can set that search up any way you want to, and if you have a list of stocks, maybe 20 to 50 stocks that you have that have shown good ROI from your research and your analysis, or maybe even another service, just use that list function to plug it in as well. Okay, another quick question that came in. Do you have teaching videos that focus on repairing trades that go sour? Yeah, there's several. If you go into the free webinars tab under the main home tab, you've got a variety of different webinars. Some on the Power Options tools. There's one we did last week, creating your own personal stock list, using the portfolio tools, track, manage, and adjust your positions, searching for covered calls, the best bull put credit spread, introductions to long calls and long puts, and so forth. Under the Option Strategies tab, you'll see things such as managing your long options positions, managing naked put positions, vertical spreads, managing your spread positions, protective option strategies, and more. It's a basic options concept here, protecting the stock or the whole portfolio, insurance, and so forth. And then the requested topics, which are mostly the open forum discussion Q&As, you may see anything, 5 ways to manage your credit spreads, let's see, weekly versus monthly options, bull put management. There's one that might work for you from April 28th, locking in gains in your stocks, and discussion on parity trades. So I think what you're looking for as far as management of positions, you can go to option strategies, naked puts, managing your vertical spreads, managing your long options positions as well from earlier last week. This week, I apologize. And then some of the ones in the requested topics here might suit your needs as well. All right. So there's a lot of videos there. We'll teach on repairing trades and fixing trades and so forth as well. All right, and Joe asked a follow-up question, and I'll just explain this to everyone. Many of you have heard me say this in other webinars before. What options trade methods from your experience has resulted in the best ROI long term? And people usually scoff when I say this, but for me personally, it's come to effect. More in-depth background, Joe, I did start working with Ernie Renner and Power Option staff 12 years ago. When I first started working with them, I was allowed to do covered calls, right? And this is before the advent of a lot of the electronic online options. Like Options Express was there, E-Trade was there, a couple others were there, but you had never heard of Thinkorswim, Interactive Brokers, Trade Monster, Trade King, for example. Those did not exist. Options House was in existence, but they were very small and very quiet. They've blossomed nicely, and they're really a good full-fledged, well, not full-fledged, of course, but they're really good platform and really good support and really good tool there at Options House. And they just recently bought out someone, I want to say Trade King, but I don't think that's right. It wasn't Interactive Brokers. They partnered up with someone recently. Trade Monster, I'm sorry, yeah. Options House sort of bought out Trade Monster recently. In any case, I was allowed to trade covered calls. So I started doing them. I followed Ernie's techniques, learned from Ernie, and, you know, I had the same experience that most investors do with covered calls. I was able to get good success right off the bat for the first 2 or 3 months, making 3%, 2.5% when I was assigned, being right about 65 to 70% of the time. And so I was making profit for 3 to 4 months, and then the fifth month, 4.5, fifth month, I had a 50-50 win-loss ratio. And when I looked at my portfolio value, it was lower than when I had started, because the 4 trades or 5 trades I lost on in my covered call brought the account value down so much that it was below where I started. And the gurus that charge you $3,000 for weekend seminars say, oh, it's not a loss until you sell it, so you can continue selling premium. But once the stock's fallen that much, when I was used to getting 3% on a $50 stock, maybe around $2 or $2.50, $3 per contract for about a little bit less than that, but $1.50 on a $5 stock to get that 2 or 3% yield. Now that the stock's down at $42, $41, selling a 42.5 call, I'm only getting 60 cents. My premium's been cut in half. Oh, it's still 1.5% of your underlying security. Yeah, but it's not really helping me repair this $6, $8 loss I've got on the stock. I'm going to need to trade this position for 24 months this way just to get back to break even, okay? Anyway, long story short, same thing happened again over the next 5 or 6 month cycle, and I decided that covered calls were not going to be a wealth option. So I actually moved into collars first. Similar concept of a covered call. In a collar spread, I'm going to buy the stock. Let me go into other strategies here. We're going to buy the stock, of course, and then we sell the call that we would. I usually sell an at or out of the money call, and then I buy an out of the money put with the same month to expiration. Okay, so static profit and loss chart, Joe, which looks a lot like, wanted to go here. A profit and loss chart that looks very similar to a bull put credit spread. It's just not a leveraged trade. Okay, so it's very even here, and we've got a nice little risk reward profile. But the advantage of the collar over a bull put or a bull call debit spread is not using leverage. Okay, if I'm in a bull put spread where I'm looking to make 50 cents, let's say I sell the 100 strike bull put. I sell the 100 strike put and buy the 95, and the stock's trading up here at around, let's say, 108. Well, I might make a 50-cent net credit on that spread. My risk is 450, so this is a 9-to-1 risk-reward ratio. So with this setup, and I still might have a 75 or 80% probability or higher, okay? But with this win-loss ratio, I have to be right 85 to 90% of the time consistently in order to make money. Yeah, I can manage a spread if it starts to move against me. If it starts to have a small loss of 25%, meaning it's instead of losing $4.50, I'm only losing $1.10 or $1.80 if I liquidated, or maybe the debit's $1.80 to close it, so I'm losing $1.30. Well, I can manage that and try to mitigate that loss. That's true. But if I just have an event where the stock goes below 95, and before I know it, because it would happen in the pre or after market hours before I could do anything, I'm now at near 100% loss, and all I can do is hold on the position and hope it comes back up so I don't take the 100% loss. But in those events, which happen more often than we think, I've now taken a loss of 450, which has wiped out 9 to 10 previous trades. Okay, you're not always going to take the full loss, but it will happen, and that's the setback. Okay, with the leveraged spread trades, bull put credit, bear call credit, bull call debit, and so forth. I traded those for a while as well, but because of time, this is what I do during the day. I'm writing articles, I'm doing coaching sessions, I'm working with other customers, I'm analyzing, helping them set up the search tool. I'm planning on other webinars. I do about 3 to 4 a week. So I didn't have time to manage a credit spread portfolio effectively because I need more time. And honestly, most of the investors I talk to, they don't want to spend all their day trading, okay? They want to do other things. But with the collar spread, I'm getting a very similar premium, maybe 50 cents or so based on what I'm investing on the position. So it's still the same premium. And I'm looking to make, it's no longer leveraged. So I might make 2.5 to 3% if the stock moves up and I'm assigned. But if the stock falls below the lower strike price, I'm only risking 4 to 5% of my total investment. Now it's capital intensive because I have to buy the stock, but I'm controlling the risk. So with this basic setup, if I'm looking to make 2.5% when I'm right and only losing 4 to 5% when I'm wrong, I only need a win-loss ratio of about 66%. Where the credit spreads, which have a parity trade, have a similar risk-reward profile, but using leverage, I need to be right about 85 to 90% of the time consistently in order to have long-term success with bull put credit or bear call credit, okay? Now, in light of that, one of the most successful, to be honest with you, Joe, the most successful option strategy I've ever traded in my personal account was for about a 7 to 8 month period, and that was in calendar spreads. I saw the most profit monetarily and percentage-wise I've ever seen with any option strategy in a 7 to 8 month period once I developed my trading plan for calendar spreads. And this was about 7 to 8 years ago. Shortly after that 7 to 8 month miraculous winning session, and I had management techniques in place and everything else, over the next 4 months, calendar call and calendar put spreads. It's not like the market just turned and I stayed in calendar call spreads and it was dropping. That's why I lost money. I was doing both calendar calls and calendar puts and had management places in mind. The calendar spreads resulted in the largest loss, percentage-wise and monetarily, I've ever taken with any option strategy. And over the course of that almost 13-month period, I ended up negative, even though the first 7 months were so miraculous and I was looking at extremely good returns and extremely good profit monetarily. I gave that all back up in a 4.5 month period to where I was actually negative after about 11 to 12.5 months of trading calendar spreads. So I moved away from that for a while. I moved away from that time. Now, long story short, is about that time that I came across Kurt Frankenberg and the married put techniques using the radioactive trades where I'm buying stock and buying an in-the-money put. It was about 7 years ago. I'm sorry, I meant to go here. And you say, okay, it has a similar risk-reward profile to a long call position. That's right, but it's not leveraged. And because I'm buying the stock and I'm buying the put, I'm more disciplined, and I'm forcing myself to be disciplined by going into an ideal size trade where I know that if anything happens, no matter what happens, I can only lose 4 to 6% maximum on the position, and it's guaranteed. I can't do that with covered calls with a stop order because the stop gap's down 25%. I get closed out for whatever the market can give me, and I've got a realized 25% loss. Same with naked puts and same with the credit spreads. With a married put, I'm guaranteed that I can only lose that 4 to 6% of what I invested, and I start with leaving my upside open, and then we can make adjustments to lower the risk on the position. Now, I'm gonna navigate over real quick. I'm gonna show you something that's one of our other sites. I mentioned Kurt Frankenberg. I mentioned the radioactive trading techniques. I'm going to go over to radioactivetrading.com right now. Okay, and at radioactivetrading.com, this is where we talk about the blueprints and the limited risk trading techniques. I'm going to go to resources. One of the resources we have is what's called the Trade Simulator tool. And what this tool does for you, Joe, is it simulates 100 trades. Okay, we can set what our target goal is for our trades, and we can set our loss limit for our trades, and then it's going to simulate flipping a coin 100 times. Heads we win and make X percent, tails we lose and lose X percent, and we can set our probability. So I'm going to go into the simulator tool here. And remember what I said about bull put credit spreads. How if I'm looking for spreads that have an 80% probability of success or higher, and at the same time, I'm looking for positions that are at least giving me, 50 cents versus a 450, that 9-to-1 risk-reward ratio, which would typically come with going 80 to 85% probability. So we're looking at maybe an 11% yield and risking 450. Okay, so let's set that. Let's say I wanted to do a credit spread portfolio, and I'm going to assume 50 cents versus a risk of 450. So that'd be 11% yield, and the loss limit. Now, we know the loss, if we took a full loss on that, would be 450. That would be 100% loss. But I'm going to close every position when it gets to, I'm not going to let it go more than 50%, okay? So I'm going to set my loss limit to 50%. What does that mean? It means the debit to close the position would be 250. So I'm not taking the full loss of 450 or 225, okay? Now, the probability of loss here is set at 50% for something like a long stock position, just as a rule. But remember, our probability of loss, we're going to keep that at 20%. Okay, so that means we're going to have an 80% on average success rate and a 20% loss rate. We're going to lose 50% when we're wrong. We're going to gain 11% when we're right. Let's take a portfolio starting with $10,000, and let's go ahead and simulate the trade. Okay, so I'll click Simulate the Results. This is exactly what I was talking about. So this simulation took these numbers, and we're investing 50% in each trade, so $5,000 per trade, okay, for spread trade. And we see a simulation of wins and losses. So right off the gate, we have 5 wins, and we take our account up to $13,000. We're already at a fantastic win ratio there of about 30%, okay? But over time, you're going to have winners and losers. Look at this track record. We got heads 81% of the time out of 100, tails 19 times. So we have an 81% win ratio. At one point, we did take our account up to a 30% gain, but over time, we're down 67%. We could be left after 100 trades, only $3,300. This isn't what actually is going to happen, but it's just simulating what you'd expect with your win-loss ratio, looking to make 11% when you're right, not risking more than 50% on the leverage trade, and being right 80% of the time. You can still come out with significant losses. So let's go ahead and run that again. 79, we expect that. 75, we're still at a loss here. I'm going to go ahead and increase our probability because that's not working. We got to increase this to 15. Oh, wow, look at that. 90% of the time, we had 90 wins, we only had 10 losses. We took our account from $10,000 to $72,000 over 100 trades. Is that possible with credit spreads? Yes, maybe. If you only never took a full loss, you kept that to 50% with your management, but you're going to have surprises where it goes completely against you and you wake up in the morning, you're 100% loss, and you'd have to be right 90% of the time. But as you know, if we put our probability in our screen up to 90%, we're probably looking at positions that have an 8% gain or a 7% gain even with the leverage because we're receiving much lower net credit. But this just illustrates, in order to be successful with that kind of ratio, looking to make 11% when we're right, knowing we could lose 100 but trying to keep it to 50, we have to be right about 85% of the time in order to make a profit. See, there again, there's 82 and 18, 82% winners. You're still at a significant loss and you didn't get above $13,000. Okay, so let's talk about another aspect, covered calls. In a covered call, my max return might be 3% if I'm assigned on my position. My loss limit, I'm going to follow IBD rules. I'm just going to put in a 7% loss as well. Okay, so or set a 7% stop loss, and that's assuming we don't have any positions that go all the way through our lower break even, or I'm sorry, that we don't have gap down 25 to 30%, we realize that loss, okay? So if we got out of every position with a 7% loss, make 3% when we're right, and let's say we're good stock pickers and we have a, probability of loss is only 35%, so we're gonna have 65% winners. Being right 58% of the time, making 3% when you're right, and losing only 7% when you're wrong, no more, which doesn't always happen in the markets. We know that because we're going to have some positions just take a full loss. We're investing $5,000 per trade. We can be right 58% of the time. We have almost a 50% loss ratio. Okay, so maybe we need to be right a little bit more. Okay, so let's go ahead and take that to 30. We're going to be right 70% of the time, make 3% when we're right, we get assigned, and then we lose 7% when we're wrong. Look at this, after 100 trades, 73% win ratio, 27 losses, 27% losers, 73% winners. We had some wins right off the gate, so we never really dropped below 9,500, but after 100 trades, max profit's only 10%. That might not be in a year, that might be over the course of 5 years, depending on how many positions you trade in a given year. Probably more like 3 or 4 years, but that's not a lot of gain, is it? For all that work of managing the covered calls, getting assigned, opening the positions, setting your stop orders, 100 trades later, being right 73% of the time, 10%. Okay? Now, I talked about the married put, where I enter any position where I have a limited loss of 5 to 6%, okay, or even less, let's say 5%. But now I'm going to leave my upside open. So if I pick the stock as I would in a covered call, and the stock moves up 8 or 9% in the first 30 to 60 days, I'm going to have a better return than I would with a standard covered call, because I'm realizing more upside. I'm actually just going to set a reasonable win target of about 7% on my winners, and I'm going to keep my losers down to 5% or so on my losses, and I'm going to put my probability of loss at 50%. So I'm only going to be right half the time. I'm going to look to make 7% when I'm right. I'm guaranteed not to lose more than 5% when I'm wrong, 50% win-loss ratio. Now that's interesting, isn't it? This is a terrible track record where I'm right only 40% of the time. Wrong 60% of the time. I did lose money, but nowhere near the percentage I lost when we saw with the credit spreads being right 80, 82, 83% of the time. Here's one where I'm right more than I'm wrong. 51% winners, 49% losers with this win-loss ratio. 7% when I'm right, 5% when I'm wrong, and we gained 60%. Okay, we took our account up to 16,000. We never saw more than a 12% drawdown. as well. Okay, so let's run it again. Look at this. I was wrong more often than I was right. 48% of the time I was wrong, 52% of the time I was right. Because of the ways the win-loss ratios worked, my account only dropped down about 2.5%, and we still went up about 40% after 100 trades. This is not what I'm saying you should expect with the married put technique, and I'm not saying this is what I expect with mine. All I'm saying is that setting this and guaranteeing this, guaranteeing the loss limit first to know that you're only risking 5%, and we were using the stock to do that and the long put to do that, so we're only risking 5% guaranteed if the stock falls against us. When you control your risk first, you can put yourself in a position where you're better off long term because you're not going to suffer that 20%, 30% loss. In the past 2 weeks, I've had 2 near profitable positions, radioactive trading positions, and earnings came out and I had a low risk position. One of the stocks dropped 35%. If I had been in a covered call, I'd have, even if I've been trading covered calls the entire time I was in that trade, I'd still have a loss of 28, 29% on the position. Because of the married put, when it fell, even though it beat estimates and it beat revenue, and its projected estimates and revenue were higher than what's forecast for the next quarter, the stock drops 35%. I'm going to lose 6.5% on that position. If I was doing covered calls, naked puts, I'd be down about 28%. If I was trading a bull put credit spread, I'd be at 100% loss. Of course, if I was trading in a bear call credit spread, I'd have the full gain of the credit, but that's a different story. If you'd done a long straddle or a long strangle, you'd have a strong profit as well. But that's why the leverage trades work against you, because you're risking 100% of what you might have invested into a long straddle or a long strangle. And you need large gains to compensate that potential loss as well. This stacks the odds in our favor. I also talked about the standard collars. Remember, that had the similar risk-reward profile of a bull put credit spread. Remember what I said, when I'm right, I'm looking to make 3%, 2.5 to 3%. So let's call it 2.75. And when I'm wrong, I'm keeping my risk to about 4.5%. And okay, so let's go 50-50. Well, I still have a loss here if I'm right 51% of the time. There's a losing track record. Okay, 53% of the time I'm still losing. And that's why I said I needed to be right about 65% of the time with my collar spreads, even controlling the risk, because I've also capped the gain. So you see here, we get close to that. So I'm right, okay, here we go. I'm right 73% of the time, looking to make 2.8% on the upper end of the collar, only risking 4.5%. If I'm right 73% of the time, I might make about a 50% gain after 100 trades, assuming a reasonable win-loss ratio. Now, another thing that you can look at here at Radioactive Trading, if you click on track record, you can see Kurt's track record from his previous trades, the trades that I post for our Fusion subscribers here, which are my trades in my actual account following the radioactive trading techniques and earnings. Well, over the last few years or so, let's see here, let's just go to the track record. This is my actual win-loss ratio, 35 trades, 21 wins, 14 losses. But remember what I said, this is pretty close to my win-loss ratio. I make, on average, 7.6% of my winning trades because I leave the upside open. I don't cap it as I would with a covered call, credit spread, debit spread, or even a collar spread. But I'm still only risking 4.6%. So that's about a 60% win-loss ratio. And what this is showing me is that if I started out with $10,000 and over time I'm able to keep this 60-40 win ratio, and I'm able to keep making 7.6% on average when I'm right and only giving up 4.6% when I'm wrong, over 100 trades, we could take this $10,000 up to $102,000 and never see a drawdown of more than 5 or 6%. That's a possibility, okay? But based on that trade simulation, it's not etched in stone. This is not my actual numbers. I have been averaging about a 10% gain in my radioactive trading portfolio over the past 6 years or so, 6 or 7 years. So long story short, that kind of answers your question, Joe. And I know I went a long way to do it, but I wanted to show you that trade simulator tool back in the resources because I want you, if you have the time later, to go to radioactivetrading.com, go to this resources link, I'll send it to everyone in the chat menu, and go ahead and click on the trade simulator. And I want you to put in what your expected gains were for your current strategy percentage-wise. What is my current gain? Remember, we saw a 50-cent net credit on a 450 risk. That's an 11% gain. So you want to put in your target gain when you're right, what you expect to make when you're right, what you're going to try to limit your losses to, and factor in that you're going to take a full loss on a credit spread one time or the other. So try to average that out, and then set your probability of success you've had over the past couple years in credit spreads, whatever strategy you're analyzing, and see how that comes out. All right, see if that works for you. See if that's going to give you long-term profit or loss. But as I mentioned, since I started doing this technique in my personal account, I started with a smaller amount of money the first year, then put more into it and put more into it. So for the past 5 or 6 years, 50 to 60% of my allocated trading of capital is in these radioactive trading techniques. Why? Because I've seen more consistent growth in my portfolio using the radioactive trading techniques than I've seen by doing covered calls. Consistently trying to do credit spreads in a portfolio. I still do credit spreads in a portfolio. I still do some naked puts. I still do calendar spreads, but 50 to 60% of it is in these married puts. 10 to 15% of it might be in those standard collars I mentioned. Another 10 to 15% might be in the calendar spreads right now, and another 10% might be allocated to credit spreads, but only on the broad-based indexes and ETFs. So the bulk of my portfolio is in protected positions where I'm guaranteed not to lose more than 5 or 6% of what I invested in the position, and I make sure that each position I open, the monetary risk I have, that 5 or 6%, only represents a risk of 1% or 1.5% of my total portfolio value. But I want you to use a trade simulator tool to see what your results are and see how you can improve them. What are you going to need to do to set your target price and your loss limit to improve them, and what your probability of wins and losses are over time. What can you do to improve them? And that'll almost dictate to you that you need to focus on the one thing you can control in trading, and that's limiting your losses to single-digit percentages. We can't control how much we're going to make when we're right. We can't control how often we're going to win or lose in any given strategy. The market's going to dictate us. Whatever, if I'm even trading covered calls, a strategy that worked for me for 6 months in a row might not work for the following 3 months because the market conditions are going to change. I'm using the same criteria looking for the same stocks, but market conditions are going to change. The only thing I can control when I invest is how much I'm going to risk monetarily and percentage-wise of my investment. And if I control that, then the profits will take care of themselves, especially if I leave the upside open to get more advantage of gains in the security, bullish, or I can reverse this and go bearish as well. But that's what I want you to take a look at. I want you to run that. And to answer your question, that's why the married put techniques and the radioactive trading techniques I'm using with 50, 60% of my trading capital, because that has worked consistently best for me over time. Okay? I've had success with my standard collar positions over time too. But in comparison, because I'm capping the gain, I don't make as much per year percentage-wise as I do with radioactive trades. I was successful with cash-secured naked puts for the most part, but I did have some rough months, and I'm sure you all have seen that as well. As I mentioned, I wasn't successful with credit spreads because not only did I not have the time to devote to it, but we saw why in that tool, in this trade simulator. To be successful, everyone likes the credit spreads because they look at the probability and say, I have an 85% probability and a leveraged 11% return. What could go wrong? Well, what could go wrong is you need to consistently be right 85 to 90% of the time in order to profit long term. If you're not, you're going to be losing money on a consistent basis, and that's not getting ahead. Okay, and the calendar spreads, of course, who knows? I still like them. I still have fun with them. I still trade them in my account, but it's just funny to me that I was so successful with them for a 7 to 8 month period, and I saw exactly what happens to a lot of investors with any leverage position. You give all of that back much more quickly than you made it, and then you're scrambling to get back to break even. So for me personally, to answer your question, Joe, that's what I feel has worked for me best with the best return on average is the married puts and the collars by controlling my risk. Up front first, not worrying about premium generation, not worrying about taking in money, but controlling my risk and ensuring my investment before going forward. Okay, so that was a long-winded explanation, but I do encourage everyone to go to radioactivetrading.com, check out that trade simulator tool, put in your numbers, and see why you're not performing as well as you expected to based on your win-loss ratio and, of course, your gains, your target gains, your average gains when you're right, and your average losses when you're wrong. All right, you want to play with that a little bit, see where it is, and it'll kind of help you understand why you're not getting ahead as you originally thought. All right. Am I saying you can't be successful in credit spreads and debit spreads? No, I'm just trying to illustrate what you need to have happen to be successful with those leverage trades. Am I saying you can't be successful with buying calls and buying puts, speculating on market movement? No, but you have to be aware of how the leverage works against you. It's not as simple as paying 1/20th or 1/10th of the stock price to buy a call to control the movement of the stock. It's about fighting time value when you buy a call or buy a put, fighting the movement of the stock, and realizing that you are in a leveraged position. You can lose 100% of what you invested in that long call or that long put. If you think about it, if you have 100% loss on it, let's say you even have a 50% loss on a position, you need 100% gain on your next trade just to get back to break even. But if I have a 5% loss on a position, if I keep it to a limited 5% single digit loss of what I've invested in the position, I don't need a 10% gain to get back to break even. I only need a 5.2, 5.3% gain to get back to break even after suffering a 5% loss. And that's much easier to manage and much easier to control in a portfolio long term. All right, well, it's about 5:30 p.m. Eastern Time. May have gone on a little bit of a rant there, but that's okay. Wanted to make sure that we not only understood which strategies work best for me, but why those strategies work best for me and why I continue to do them and why I advocate them for other investors who are not having success with the current strategies that they're using. All right, but if anyone has any last-minute questions, please go ahead and send those in to me here. As I mentioned, it is 5:30 Eastern Time. I'm more than happy to stay on for an extra 5-10 minutes or so if some other questions come in. While I'm waiting to do that, let me go ahead and, whoops, sorry about that. I'm sorry, folks, 1 second here. There we go. All right, while I'm waiting to see if any questions come in, I just want to remind everyone of course, the Power Options tools. We have different levels of service. If you haven't done so yet, just go to powerup.com. At powerup.com, you'll see the name and email address over on the side. Just put in your name, put in your email address, and click Start My Trial. And that, of course, will give you access to the 14-day free trial. Our 20-minute delayed service, it gives you access to all the tools on the tool menu. That, of course, is $60 per month. And then you can upgrade that. The 20-minute delayed service plus access to our historical tools is $100 per month. And the real-time service, where you still have access to all the tools and power options, but every time you run a search or refresh the page, you're getting the numbers and calculations at that very instant. That's $100 per month. And of course, the upgrade to that, you can go to the real-time plus access to the historical tools for only $140 per month as well. And upcoming events, Monday at 4:30 p.m. Eastern Time, I'm going to host a presentation on how I use power options to research and analyze a new options position before opening it. Tuesday at 12 p.m., Kurt Frankenberg is going to host one of his radioactive trading presentations, going to show you the basic setup and some of the ideas and concepts of radioactive trading. And then Wednesday at 12 noon Eastern Time, I'm going to show a discussion on searching for long options using the power options tools as well. And before I go any further there, I just want to navigate back here to our view. Before I do anything, let's just, oh, there we go. Sorry, folks. I want to go back to radioactive trading very quickly. Remember, go to the radioactivetrading.com. Go to Resources tab here. Check out the Trade Simulator tool. If you want to see more on the concepts of what I'm doing in my personal account, and if you haven't been introduced to radioactive trading before, click on the Free Webinars tab. It may ask you to input your first name and email address, but just go ahead and click on the Free Webinars tab, and Tuesday's presentation that Kurt did is available there to give you more insight into how we're approaching the radioactive trading techniques and why it's going to benefit your portfolio long term. All right, so check that out at radioactivetrading.com as well. In addition to that, of course, on both power options, oops, sorry folks, go back there, both on radioactivetrading.com and powerup.com, just go back to the main homepage there. If you click on webinars at powerup.com, you can access our free webinars page. It is a public page, but you can sign up for the upcoming webinars later next week. On the 27th and the 29th, you'll also be available to sign up for the radioactive trading presentations as well going forward. All right, Marvin asks, I use the IBD 50 list. Do you update that list every weekend? Actually, Marvin, I think we're updating it more than that. I think IBD began a couple of months ago to update that list every other day or every 3 days, essentially. I think it was on Monday and Thursday. I can't remember what their days are. We are updating it, as far as I know, at least every weekend, but I'm pretty sure, I'm almost positive, we're updating it twice a week. And then the canceling list, I think, only gets updated once every 2 to 3 weeks. But the IBD 50 list, I'm pretty sure, I'm almost positive, we're updating it about twice a week when they come out with their new updates as well. And all the other lists are updated on a regular basis also in that scenario. Okay, so just flash back to this real quick there. Sorry, folks. The upcoming webinars there, you'll be able to register for them at powerup.com or at radioactivetrading.com. And at any time, you can take a look at powerup.com/webinars.asp to review our archive webinars, see what new webinars we have coming up as well. All right, ladies and gentlemen. Well, I don't see any new questions coming in. Thank you, Marvin, for your questions. Thank you, Joe, for yours, of course. And thank you, Dom, for your insight there and your discussion that you had just put in there, too. If you think of any questions later on, please feel free to send me an email to support@powerup.com. Remember, you can also reach us during market hours at 302-992-7971. Of course, there's contact links at the bottom of every Power Options page. Well, I guess that's all I have. I don't see any other questions coming in. I hope you all have a fantastic weekend. I hope to see you live next weekend for some of our upcoming presentations as well, or next week, I should say, not next weekend, but next week, some of our live presentations as well. Take care, everyone. Happy trading. We'll see you soon. Good night.